We all thought that the COVID-19 pandemic was the worst thing that ever happened to salary earners, but that's because we didn't see the tech storm coming. First, Twitter decided to downsize its workforce. Next came Google, following closely after Elon Musk's footsteps. Now, Spotify is hopping on the trend too. What's going on? Ever since the COVID bubble burst, literally, all our big tech faves have been laying off a chunk of their workforce. Meta Platforms made its largest wave of employment cuts since coming public in 2012 by eliminating 11,000 positions in November. The corporation attributed its decision to decreased advertising revenue and increased expenses in its reality lab segment. Shortly after this, others in Silicon Valley soon followed. Meta's move seemed to open a floodgate that they had all been waiting on. Microsoft followed closely after, with a plan to slash out a total of 10,000 jobs. Google is also clocking in, with the elimination of 12,000 jobs. Apple has managed to stay out of the fray. Instead, the company chose to freeze hiring. Amazon has also joined the pack. It recently confirmed that it would cut out 18,000 jobs, affecting roles in upper management positions, PXT organization, and Amazon stores. Soon after Elon Musk took over the control of social media giant Twitter, he fired 50% of the company's staff and has reportedly laid off at least 4,400 contractual workers. Oh yeah, and Cisco too. Along with other tech companies, the IT company has reduced its employees. Over 4,000 people are apparently being let go as part of a rebalancing effort as it right-sizes certain industries. Now to the latest news on the downsizing trend that's sweeping through the US tech industry like a whirlwind. Spotify is laying off 600 workers. It has joined the ranks of tech companies laying off workers as 2023 begins. But wait a minute, why are tech companies laying off their workforce? Is the recession here already, or is it something else? No doubt Western countries are on the brink of recession, and more nations will join them soon if they aren't careful. But that's not the only reason why giant tech faves are restructuring. In many respects, the significant round of layoffs is a correction for an earlier era, the pandemic hiring frenzy. Our online lives ended up being our only life during the epidemic years. There were no Saturday night bars, no commuting to work, pick-up basketball games, or dance recitals. We were all compelled to stay home, which resulted in more internet time. Despite the upheaval in the world, this internet activity increase benefited tech firms. They brought in record high revenue, which led to record high profits, and a hiring frenzy that resulted in high compensation and perks for engineers, developers, and other tech professionals. Many tech firms assume that this was the start of a new normal. They couldn't have been all wrong. If a Meta team, for instance, needs 25 people to keep an application they are working on up and running, 30 or more actual employees would be hired. Not necessarily because there is enough work for 30 engineers to complete daily, but rather to protect the business in the event that several essential employees leave. Another cause of this human resource mishap is the post-COVID reality. Yes, working remotely has gained a lot more acceptance. Today, a lot of office professionals have flexible work schedules that allow them to work from home occasionally, but hybrid work has also grown significantly in popularity. We've moved past the days of having every meeting hosted automatically online, even though tools like Zoom and Google Meet are still widely used. The situation is considerably more complicated outside of work. Life outside of work is quite similar to how it used to be before the pandemic in many aspects. Weekend sports have begun, bars and restaurants are once again busier, and vacations have returned. After 2 long years of sobriety, many people are even more fascinated by these things. The end result? Too many individuals were hired by tech companies, and these are highly skilled software engineers and developers earning low to mid 6-figure salaries, not part-time administrative assistants making $10 an hour. Clearly, they went too far. If they genuinely just hired them a little too early, hiring too many individuals shouldn't be a problem. Having such roles on the books a year early won't break the money for businesses like Meta or Alphabet if you anticipate hiring them in 6 to 12 months. The problem is that the near future doesn't appear to be very promising. It has been reported for several months that the US is ostensibly entering a recession. One of the first to call it out is Coinbase CEO Brian Armstrong. Elon Musk, Mark Zuckerberg, Jeff Bezos, and many others have since done the same. With these headwinds on the horizon, tech companies need to rein in their spending to ensure they safely get through the volatile period. But is that really the case for Spotify? Seems like the Spotify case is more of a poor decision. Daniel Ek, co-founder and CEO of Spotify, wrote in a memo to the company's staff that he hoped to maintain the pandemic's strong tailwinds. He had thought that their large worldwide customer base and lesser vulnerability to the effects of a slowdown in advertising would protect them. In hindsight, I was too ambitious in investing ahead of our revenue growth. What investment, you might ask? Spotify made podcast investments, very costly ones. The dominant provider of music streaming looked to the podcast industry to increase revenue between 2021 and 2022. The business has invested more than $1 billion in the sector to replicate Apple Podcasts' success level. This includes purchasing the exclusive streaming rights to the divisive podcast, The Joe Rogan Experience. Notably, Spotify's leadership has significantly transitioned due to the layoffs. Dawn Ostroff, the company's chief content officer, and the person behind the podcast project are leaving. Sadly, it appears the significant promotion of podcasts only led to 7% of all Spotify listening in the first quarter of 2022. Specific popular broadcasts have become more exclusive because of the subscriber-only model. A lack of users has resulted in sharp declines in listenership. The firm decided not to renew its exclusive contract with author and influencer Brené Brown and recently put a freeze on its US budget for new podcast programming. The expense of trying to catch up with Spotify, which seems to have missed the early pandemic podcast explosion, will be felt by its listeners and its staff, of course. Some of those reductions might have even had an impact on your favorite podcasts. Just like with playlists, there are priorities. Should this layoff really be their next move? If they can actually measure the same output with a less than labor force, why not? But if they can't, we see no reason why they should shrink their workforce. Why does the workforce always have to suffer for the company's bad decisions? Before, 2 years at a company constituted an excellent career, but the times have changed. The last employee hired is now the first sacked. Employees are now reassessing their commitment to organizations with a focus on culture. There is far less turnover. The majority of these businesses hired a ton in the previous 2 years. Clearly, they're overstaffed. However, the layoffs have exposed a lot of old wounds. The economy is suffering. Is there hope for fast regeneration? Overall, we'll actually see more layoffs coming. So get your shields and helmet in place because there are many more painful and fiery darts in the line of advance.